Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Wednesday, November 19th. We have got a great show lined up for you today. First up, the debut of the Information's new finance newsletter. We'll hear from our finance editor on why he's launching that newsletter now, in this moment, and all the different ways that he is thinking about the AI finance ecosystem. We'll then talk to the co-heads of General Catalyst's Customer Value Fund, which has deployed $4 billion so far. And we're also talking margins and AI with Amazon Web Services Director of Technology. And finally, we are closing out the show with a conversation with Caspar Lee, the co-founder of the venture capital firm Creator Ventures and a longtime YouTube sensation himself. It is a big show, and so let's get right on into things. Today, The Information published its first ever finance newsletter. It will publish weekly on Wednesdays and will be written by our own finance editor, Ken Brown. So we're bringing Ken on today to talk a little bit about what prompted this newsletter and what he's thinking about. Ken, welcome to TITV. It's great to have you back.
Hi, Akash. Oh, good to be back.
Well, I made this joke earlier today, and I'm going to make it again. Big day and big debut for you with your column. Congrats.
Oh, yes. Thank you so much. Yes, it's very exciting. It's fun. It's fun to write. I'm an editor here all the time, and so to get to really write my own stuff is a treat.
So talk to us about what prompted you to launch this newsletter now, today.
Well, it's no surprise that money has always been a big deal in tech, but now it's bonkers, right? I mean, we used to talk about millions and billions, and now we talk about trillions. And so, just the movement of money around tech and what's driving, especially the AI boom, it begs for someone to just look at it through a financial lens.
Right. And now when you say financial lens, talk to us about all the different angles that you look forward to double clicking on, because your column today was a really great overview of honestly what I thought to be the entire story. I kind of read it and I said, okay, well, that's it. That's the story. And so what are the areas that you're looking to dive deeper on in the coming weeks?
So you're never going to read another column, right? That's what.
Well, no, it's kind of like it's a bit of a page turner. It's like, okay, well, I didn't know it was more complicated than that.
Right. So we're going to track the AI build out. We're going to track all the money pouring into AI, and watch who's winning, who's losing, how they structure all the money, and probably most importantly, where the risk is building up. So everyone talks about bubbles now. One of the things I say today is we're not there yet. And one of the reasons is because this whole big build-out explosion of AI is backed by the richest companies in the world. These guys can write checks, not for trillions, but they can write a lot of checks. They've so far paid actually for most of it. And so, that is, it's going to be what we're looking at. But then, the bond market's going to finance it. Sovereign wealth funds are going to finance it. Pension funds, even your life insurance policy might be invested in the AI boom. And so we're going to track all that and look for risks, surprises, things people should be wary of. And we're going to try to explain it all very clearly.
Now, you say we're not there yet in terms of the bubble. I'm curious, compared to some of the other bubbles or some of the other frothy periods that you've covered throughout your career, how does this one look and feel different compared to those?
Well, the first thing is bubbles can last a lot longer than anyone thinks. People call for a bubble and 2 years later, they're still calling for a bubble. I'm always a little skeptical of that. And the reason is, in this case, there's just tons of money going in, and we don't, and there's no reason for there to be a crack because all the people who've been borrowing money have time to pay it off. So this one is different. Well, one, is different because it's backed up by the richest companies in the world. Two, the businesses it's funding, say what you want about the dollars, they're growing very fast, and they're having a lot of revenue now. They're not having they're nowhere near making profits, but so that's a real question. But that's going to take a while to see how it plays out. So this is not, we have another. So right now there's a crypto bubble that's bursting, right? So crypto is down a ton.
Right.
All these people who loaded up are suffering. They're losing half their money. Like that's a bubble. That's just short. It goes up, and there's no logic to it. And it was just, euphoria, and that's over. This is a big fundamental change, and it's not going to be smooth. There's going to be bumps, but there's just a long runway to see where this goes.
Right, right. One of the things I wanted to ask you about is you outlined some of the places we might look for signals in terms of risk, where the cracks come from. The
Right,
stock market is one obvious place you could look, right?
right,
I mean, Nvidia reports earnings. Earnings, let's say, don't come in as people expected. Fine,
right.
that's one way people might get the signal. But I'm wondering behind the scenes, certainly thinking about the bond market and how some of these markets work in the back end. Where else are you keeping track of in terms of fault lines or cracks that could potentially show up?
Right. You start to see concentrations of risk, right? Where people are taking on the risk that other people might not want to handle. And they may be smart. I mean, people handle risk all the time, but you look for where that's happening and you try to unpack it. So we've done a ton of stories on NVIDIA, which is backing all these AI startups. It has a real incentive for AI to grow because it sells the chips. And it's one of these things. If AI's growth slows, NVIDIA sells fewer chips, the commitments they have made might be harder for them to make. And so you just need to understand what the triggers there would be.
Hmm.
Some of the data center builders, it's such a capital intensive operation. Some of them have taken on a lot of debt and taken on that level of risk. And one
Hmm.
thing to look for is, do they fall behind schedule? Can they
Right.
not produce the data centers that are supposed to be? Can they not get the power? Can they not get the chips? That's going to be a trigger for some of those guys.
Right. And last question for you. Behind the markets, there are people
Oh
and
yeah,
characters that we like to track. And there are the characters that we all know about, the founders of these companies, the
right.
executives of the hyperscalers. I'm wondering if there are people that we may not be paying as much attention to that you are actually watching very closely as an interesting character in
Yep.
this finance ecosystem.
Yeah, so I'll give you two. One is this guy Mark Lipschutz.
Okay.
He is the head of Blue Owl, which is a investment firm, mostly deals with bonds, but
Right.
they've done a lot of riskier
In
stuff
the news today.
in the news today. They've been in the news every day. They keep doing big deals, but they've turned out to be a big investor in these big projects, and so they're smart guys. They're taking on risk they think is reasonable, but they're someone to watch. And the other person I'll say is Michael Incherator, who's the CEO of CoreWeave. So CoreWeave is a data center developer
Right.
and cloud company, and they are one of these companies that's borrowing a ton and making a big bet on AI. And so far, they've done pretty well. They had a huge IPO. The stock is down a bunch, but the company is still happening, and that is uh, another one to watch.
Right. Great. Well, Ken, congrats on the launch of the newsletter.
Thank
It's
you.
one that we'll be reading and watching very closely and look forward to having you back again on soon.
Anytime. Thanks.
Talk to you soon. Okay. General Catalyst has been one of the most innovative companies in venture capital as of late, with its move to buy a hospital system recently and its expansion into wealth management. The company also set up a new type of fund a few years ago called the Customer Value Fund. It has supported companies across sectors, including software, consumer, healthcare, and fintech. Joining me now are the two managing directors of the fund, Pranav Singhvi and KV Mohan. Gentlemen, welcome to the show. It's great to have you here.
Likewise. Thanks for having us, Akash. Really appreciate it.
So,
Be here.
KV, let's start with you, KV. And look, I don't know who likes to go first in these things. So, Pranav, if you want to go first, by all means,
Happy
jump in. But the first question I have is who's going to explain to me what the Customer Value Fund is? Because, look, it sounds like a bit of buzzwords up front. So, we got to get into it here.
Sounds good. I can take that one and KV can add to it if that works for you.
Sure.
So look, the Customer Value Fund is quite simply, if you think of a technology company, once it reaches a certain size and scale, the vast use of its own cash is to invest it in sales and marketing, the tech nomenclature for which is customer acquisition cost. And what these companies do once they reach a certain size and scale, they're constantly investing their own cash in sales and marketing to generate lifetime value, customer lifetime value. What happens with these companies is a lot of that cash constantly gets tied up in customer acquisition cost, and they have to constantly keep reinvesting because they invested today and it gets realized over some period of time, say 12 or 24 months. And then over time, they may make multiple times their money on their investment in CAC. The Customer Value Fund was really designed to solve the problem of the fact that you have to invest today and it takes you some time to realize your return on sales and marketing. And that is a huge cash drain on a company's own balance sheet. So what the Customer Value Fund does is goes to companies and says, instead of using your own cash to fund sales and marketing, we will provide you a dedicated balance sheet to fund your ongoing sales and marketing spend. And in return, we only get paid back from the specific cohorts of customers we helped you acquire from that spend until we hit a target return multiple. If it works, we get our target return multiple. If that specific cohort underperforms, takes longer to pay back, or on the extreme downside does not pay back at all, we own the full downside risk. We have no recourse to any other part of the company. So it really helps companies be a lot more front-footed about growth and scale their investment in sales and marketing.
No, how do you think about it's not debt, it's not equity in terms of the return? What does that look like from your end?
Yeah, I mean, look, I think we reject the notion that there can only be two financial products. I mean, if you go outside of the little bubble of Silicon Valley, you'll see all sorts of different financial products that exist in the market. The right analogy to think about what CVF is, it's really a lot of inspiration is taken from asset-backed financing. We're effectively treating your investment in sales and marketing as an asset and providing what looks and feels like off-balance sheet financing. And so it's just a completely novel way to fund your growth in a way that has not existed for this industry before. And it allows founders and companies to unlock all the cash they have to constantly keep reinvesting in sales and marketing to go do something else with, something that's much more productive. That is investment in product, in engineering, in M&A, and over time, if it makes sense, even buybacks. So hopefully some of the VCs can realize the elusive DPI that everyone's been missing.
Right. KB, tell us about some of the companies that you've backed with this fund so far.
Yeah, absolutely. We have backed over 60 companies by now. In the last 5 years, we have seen tremendous growth. And also in our companies, some of the companies we work with, Lemonade, it's a company which is public. We work with Grammarly, which is now called Superhuman. You may have seen the announcement.
Right.
One of the companies that we worked with was this gaming company called Superplay, which was recently acquired by Playtika for around $2 billion. And across the board, we work with companies in healthcare, in consumer, in finance, across in enterprise, basically across the field. Any company which has found product market fit and has long lifetime values is a company, and wants to go from good to great, is a company we like working with.
KB, I want to stick with you on this. When you think about customer acquisition costs, the cost is one thing. The method in which you actually acquire those customers with respect to what you invest these dollars into, I wonder if that has changed at all in the last few years, given the shifts we're seeing in customer behaviors, where they live online. B2B is obviously a bit of a different game, maybe a little less, maybe changing, less quickly, I guess. But how are you guys dealing with the ways in which your portfolio companies acquire customers using that money?
Look, what we always tell people is we help putting fuel to the fire. We cannot create the fire ourselves. The best people to create that fire, to figure out how to grow, are the founders.
Right.
And we actually don't opine on how these companies should be spending. What we actually do opine on is most companies are massively underspending. What I mean by that is they need to run more experiments. The best channel always changes. Whether it's going to be, like billboards or Facebook ads or just hiring a sales team, or honestly, we have seen a lot of companies do really well even on TV. Our goal is not to opine. Our goal is to allow the company to experiment, because that is how you figure out. And as things are changing, channels get saturated, they get desaturated. You want to keep experimenting and making sure you're maximizing your enterprise value.
Right.
And that is how we think of spend. We think of it in a very broad lens.
But Pranav, I am curious, the ways of marketing from the outside, how have you observed those ways change in terms of what's effective? Because, Facebook ads, they may have worked very well 5 years ago. They might not work as well right now. So what are the newer strategies that you're seeing companies take on to acquire those customers?
It really depends. It's very company specific. There will be some companies for whom Meta still works really well. Ultimately, it is a very company specific thing. But to your point, we are very excited by new ways companies can go acquire customers. People are using all sorts of different techniques, not only just based on channels, but other ways of getting in front of customers. It will vary from company to company is the reality, because it's going to be very circumstantial based on, are you a consumer company? Are you a B2B business? What is the right way to get in front of, if you're a B2B business, the person who's your actual buyer? What's the highest propensity to buy for somebody on the consumer side? That will all actually be a function of the company itself. But to your point, and what KV mentioned, to really emphasize that these companies need a diversity of channels, and they have to constantly experiment to find out what works, because growth is a highly experimental endeavor. You'll find a channel that works for a time period, and then it saturates, and that interim period, you have to keep looking for other channels, and a lot of that will be through experimentation. And once you find something that works, then you sort of scale it again, and you keep going through that journey.
KB, as you're looking for companies to invest in this period where it seems like valuations are high and we're in this sort of talk of a bubble, how do you tune out the noise, and how do you really adjust your criteria for assessing companies in a way that sort of accounts for the froth, as people say?
Yeah, look, Pranav and I are not in the business of identifying the next Steve Jobs. I know a lot of folks are in that business, and I wish them the best. We are in the business of doing math. What I mean by that is the way we actually work with these companies is we get that raw transaction level data, which is, my background is technology. We work with these companies, we connect directly to the data warehouses, and you're getting the raw transaction level data. We are underwriting math, and math doesn't change over time. It is the same.
Hmm.
So for us, our criteria has always been the same, and there are companies that we pass on that I obviously won't name them, that you probably consider to be hot companies because they have not found product market fit. And our definition of product market fit is very simple. It is, can you spend $1 in your growth machine and consistently generate an ROI based on that?
Right.
If you can do that, and if we can see that, over the last 12, 24, 36 months in the transaction data we're getting, in all the statistics that we are running, that is the kind of company we want to work with. And it turns out, despite all the crazy valuations, there are an insane number of businesses which are still fantastic businesses that, in our opinions, and I would say, like, we feel very confident about this, are still massively underinvesting in growth.
Right.
Yeah,
Pranav, I don't know if you want to add something.
No, if I can add to that, look, valuations go up and down based on macro environment that has nothing to do with the fundamentals of a company. And so it's actually, we're quite fortunate that, we are not basically indexed on the valuations going up and down, or the stock market, the stock price going up and down, because we do work with publicly traded companies as well. And
Right.
we're solely focused on a company's ability to spend $1, acquire a customer, and to retain that customer to generate an ROI that makes sense. It's an extremely fundamental product. And look, the prices go up and down. We're kind of sort of completely isolated away from that.
Right. Last question for you, Pranav. I read that KV on his bio, he said that he likes fitness classes. Given that you guys are a bit of a dynamic duo here, Pranav, do you know what KV's favorite fitness class is?
I would hope that he's working with Ladder and using Ladder, because that's one of the companies we're invested in. But I don't know,
Okay.
KB. You should probably-
KV, what's the class we got to go to?
I used to love a Rumble in the marina, which unfortunately shut down. So these days, my friends have been trying to get me more into Pilates. Although I think it's more of
solid core.
Haven't really made it more than once or twice yet. So it is a while before I find my new fitness class. Looking for recommendations.
Okay, great. Well, when you're both in New York, come to F45. That's the class that I love, and we'll both get a workout in.
Awesome.
All right. Well, thank you to the both of you for coming on. We really appreciate it. It's a very interesting way of looking at venture, and we'll have you back on the show again soon.
Thanks so much.
Thank you for
Bye-bye.
having us.
Okay. Well, our next segment is with our presenting sponsor, Amazon Web Services. Margins have been a big topic related to the AI boom, as companies all over are trying to figure out not just how to generate revenue with these new tools, but also turning a profit. I want to bring on Shaown Nandi, a director at AWS, to give us his take on how companies can make the technology work for their bottom line as well. Shaown, welcome back to the show. It's great to have you here.
Good to see you. And I'm nervous you're going to ask me about my fitness preferences instead of AI for a minute, because I don't think I have good answers for that.
Okay, I was going to say, you're welcome to answer that question if you want to start with.
Maybe I'll check out your class.
Okay. Yeah. All right. Well, so let's talk about AI, which I presume you're a little more comfortable talking about. One of the topics that we've been talking about a lot here in the newsroom is how companies make money from AI. And I want to get your take on how you view this issue on the ground and how you're seeing customers grapple with that issue. Because from our view, there's a lot of revenue, earnings are harder to come by, the costs are pretty high. How are you thinking about that issue?
Yeah, look, I think that it all comes back to understanding ROI. And I'll give you a couple externalities that are throwing off the ROI concept. I'll start with that. When you're doing an AI solution, using agentic especially, you have to think about, are you trying to remove costs from your business, or are you trying to improve your revenue, your top line growth? Is this product driven? Is this adding new functions and features that people are going to pay for and buy? And we saw a lot of pain with software companies in the early days of generative AI, where we often refer to them as ISVs, but the software companies that sell various products to customers, they're like, I know my customers will like this thing. I'm going to build it. And they didn't necessarily think about how they're going to monetize it. Are they going to charge for a new SKU, a new product feature, or is it going to improve customer retention? And so not doing that upfront thinking sort of broke the ROI model. The second piece would be communicate that with your finance partners and teams. Is this revenue driving? Is it cost eliminating? When you have those metrics and measures, it becomes much easier to make that decision. The last piece, and this is probably the one you're going to want to unpack, is, we talked on a prior show about inference and inference costs, and we've talked about all those pieces, the aspect of running AI. We see inference costs dropping by 90% over the next year or two. And so I know that's been a hotly debated concept, but when we look at inference costs coming down, the amount of return you need to make something profitable changes radically. So lots of use cases are getting unblocked as you bring costs down.
How do you see those inference costs coming down? What are the inputs into that? Because as you correctly pointed out, we in our newsroom, we've written stories about how the costs of not just the chips, but the models, right? I mean, the costs were coming down. They've kind of plateaued based on the data that we're seeing. I'm curious how you see that shaking out over the next year or two to bring those costs down.
Let's talk about a couple elements. So when you think about AI today, and we often talk in the public about AI as a big broad thing, but there are many elements within it. One element of AI is actually building all these complex models. All the frontier model providers are putting lots of effort along with startups and building the next great model, tuning models, et cetera. And honestly, a lot of the AI consumption from a chip perspective, from a compute perspective, is driven toward training and tuning those models versus actually using them. And that's the change that we're seeing right now. The consumption is shifting to usage. And usage is what we largely call inference. So a lot of the reporting that's been done to date just looks at that broader AI landscape and says, hey, chips are getting bigger. They're getting more expensive. We're seeing higher parameter models. Models are increasing in price. Maybe even tokens cost more this month than last month. But if you look at what's changed in the underlying footprint, we're seeing more and more diverse types of chips. You and I have talked about purpose-built infrastructure, chips designed for AI in different shapes and sizes. You're also seeing many different types of models. So at Amazon, we have our own Nova Micro model. It's a very small model used for specific use cases. It's text only. In the rise of agentic, we're seeing these smaller models get used for simpler tasks. And that drives average cost down. And so one of the things you can look at, you asked me what the elements that make it up are you just using the single biggest chip, or are you using different sizes of chips for different workloads? Are you just using one general purpose model that can answer any question, or are you using smaller, more specialized models? And agentic really unlocks that. A couple more techniques I can tell you about, but that's sort of the landscape.
Well, no, and this actually relates to the discussion we were having last time on the show about chips, and you basically talked about the routing of the inquiry or the request to using a specific type of chip, maybe not needing the best in class chip just yet, given the pricing, using something that is a little more feasible or appropriate in terms of the request. I am curious, you gave that 1 to 2 year timeline. What are some of the challenges that you're seeing customers grapple with now then as they sort of work towards hitting that goal in the future?
I'm going to harken back to a conversation we had many months ago on chief AI officers and people things and so on. One big challenge is our mental model towards software development and product building is really changing. You've heard about agile methodologies and other things, but typically you ask permission to build something, you build it, you get it out there and you iterate on it for a while and it survives for years, maybe many years. What we're seeing happen now with AI that's been really hard is you go build a use case, you're like, oh, this thing's really expensive.
Right.
But if you iterate on it and it gets 90% cheaper in a month or 2 or 3, that really changes the economics. And if it scales up and goes from being used by like 10 users to 1 million, that also really changes the economics and revenue flow. So I think actually the human side has been hard, this rapid state of pace and of change.
Right.
And the willingness to say, hey, this thing's not working, I'm going to fail fast and drop it and move to the next project. And that could be a cost efficiency project or a new product, right? Could be either side of the equation. And combine that with the challenge around, but I don't want to give up before I've iterated a little bit. Like, how do I find that tension?
And so on the human side, this is kind of interesting because one thing we haven't talked about yet is the spate of acquisitions that have been sort of becoming more frequent in the AI sector. And these are acquisitions of public companies buying startups. These are public companies buying other public companies as well in some cases. I'm curious, the human side of that is interesting because there is certainly the talent component. But with respect to the technology, how do you see your customers dealing with the question around, is it more appropriate to build or is it more appropriate to buy? Yeah. Because again, you're bringing in 100, 200 employees, some of whom are very technical as well. And the human side of this is the teams have to work together too. They got to figure that part out.
I think it's a constant question, especially from enterprises and mid-market companies to me, which is, hey, I have all these vendors. I have a HR product software vendor. I have an ERP vendor. I have a CRM vendor. Do I inherit their AI solutions and features or do I build my own? And the tension is that building your own has never been easier. Like with AI-driven software tools, you can build really fast. But the mental model I asked them to think about is probably three things. Does the thing that you're building bring unique value for your customers? Or is it relatively undifferentiated? Because if it's relatively undifferentiated, you probably don't want to use that limited talent pool to build it. You want to buy it from a vendor, from a partner. You want a friend to help you with it, however. Is your organization ready? Like if you haven't worked much with AI, I just told you about this concept of failing fast and moving quickly and being able to cost optimize and use different models. If you're not ready, then you might end up costing yourself a lot more time and effort than buying. And really, the most successful companies right now are doing both. They're buying some of these common sort of shared horizontal use cases and building the things that are distinct, especially when they can use their data, because data is the differentiator. You just don't want to be the same as every company down the street from you.
Right. Great. Well, Shaown, it's always a pleasure to have you on. Thanks for coming on and engaging conversation. And I look forward to having you back again on soon.
Looking forward to it. Talk soon. Cheers.
Talk to you soon. Okay. A few days ago, we had the CEO of Beehive on the show to talk about their new tools for creators. Today, I want to bring on one of Beehive's investors, Caspar Lee, who invests in companies at his venture fund, Creator Ventures, to give us a bit of a view on the ground around the current state of play in the creator economy and how the game has changed lately in the world of influencers. Caspar, welcome to the show. It's great to have you on.
Lovely to see you. Thank you for having me.
Let's talk about the creator economy. It is a fast-moving and dynamic ecosystem to play in. Look, fundamentally, it's more competitive than ever, right? You have AI that has very much changed the game. You have more creators than ever. I'm curious, when you're talking to this group, what are the biggest challenges that they're facing on the ground right now?
So I used to make videos. I started in 2010, and when I started, you could build an audience and you could kind of guarantee that a bunch of those people who subscribed to your channel would see your content when you posted it. It did make it harder to build an audience because it meant discovery was harder. Today, it's easier to build an audience, but it's a lot harder to retain.
Right. Why is that?
It's because we've gone from a subscription-based algorithm to an interest-based algorithm, and you're basically fed more of what the algorithm knows that you want to see, which ultimately keeps audiences on platforms for longer, but it can also make it really difficult for creators.
Okay. And so how do you see creators dealing with that issue then?
Well, look, it's tough. I mean, you have to consistently fight against, becoming boring. You have to constantly put out new things that excite your audience. You can maybe create winning formats, or you can create content based on what people are interested in on the algorithm. But yeah, it's constantly about pushing yourself as a creator, and you can't just rely on your relevancy or the fact that you've built up this audience. You have to figure out how to create better hooks. You have to push yourself further. You have to come up with really unique creative content. You also have to collaborate with more creators so that you can be discovered. There's so many things, but it is really, really difficult. However, the rewards for making good content do mean that you can really blow up faster than ever too.
Right. I'm curious, you talk about the reliance on these audiences for some creators and how that can be problematic in some cases because there's actually no guarantee that that audience is going to see the stuff that you put out based on the discovery engines now. When you talk to creators now, I mean, is the move or the end game to sort of build an email list then, or some kind of an audience that you own with a newsletter? That kind of seemed to be in the early days of blogging, right? That's where the creators kind of started. Then they came to social media and it was like, well, I have them all here. Why do I need an email list? Now I hear people saying, no, I need to build the email list. That's the end game.
Exactly. It's really good to build something beyond what you have on social. So that could obviously be with like the tools of Beehive. They build incredible tools. That could be email lists. That could be coaching. That could be all sorts of things now with the new release. But yeah, I think creators need to leverage their audiences while they can to build a sustainable business that doesn't rely on their relevancy. It is really hard, though, to take audiences off social platforms because these are still the most effective places to build audiences. And this is where the audiences generally are. And I think everyone who tries to launch, like a lot of creators try and launch their own apps and stuff like that. And it's really hard to get a big segment of that audience to stay somewhere else. So yeah, ultimately it's about building, I think, rather than just, taking them to another platform, it's about building a sustainable business outside of just being a creator. And that could include another platform like Beehive. That could even be what I ended up doing, which was like co-founding a business that meant that I didn't have to rely on my relevancy, but it's tough out there.
Right. Talk about the business that you founded. Why did you decide to create it?
So I co-founded a business called Influencer.com about 8 years ago. And I wanted to help creators have more options to do brand deals. Back then, like there weren't that many brands willing to work with creators, and we had to figure out how to convince them, along with the big agency holdcos, that this is an incredible space to invest in. And since then, we've done that. And then I'm also a partner at Creative Ventures, which has invested in some incredible consumer internet companies. And we really like to help them when it comes to social, when it comes to go-to-market, and it's been a great few years so far.
Right. I want to talk a little bit about your journey in the creator economy, because like you said, you started creating these videos when you were quite young. Before you started to get traction, do you remember the first video that you ever made?
Oh my gosh, it's so embarrassing. I made a video about what was more difficult, bathing or showering. So bathing, actually, for your US audience, or showering. And
we can call it bathing too. We can call it bathing.
Okay, cool.
What was the consensus?
I said bathing was harder because it's really hot when you get in. But that's what I thought that people wanted to see. I thought that was content, and I was completely wrong. It really flopped, and it took 2 years to get to 1,000 subscribers. But over time, I started to figure out what people wanted to see.
Okay, and I'm curious, how did you approach your strategy as a creator, then figuring out what people wanted? Because, like you said, I mean, the game has changed, but in some ways, I've seen your videos. You tried a lot of different stuff. I mean, it's hard to put you in a box in terms of, I do games, I do pranks, I do lifestyle, I do reviews. You seem to have done it all.
I tried it all. I think one of the things that was consistent was me being this, young person. I hate the word authentic, but truly just being myself on camera. And then, I use the 3 C's mantra, which is like, just be creative, be consistent, and collaborate with as many people as possible. Back in those days, if you could like make a video with someone with a big audience and you both spoke about each other's content, you could like nearly double your audience. It was so easy back then to kind of collaborate your way to subscribers. Now it's still a great tool, I think, for people to work with each other and get into each other's algorithms. But as I said, like, subscribers are no longer as important. So you need to constantly be collaborating and constantly creating amazing content.
What was it like to grow up on camera, putting so much of your life on YouTube?
It was fun because I had complete control, and it wasn't like I was a child star who was put into this incredible position where I had this massive audience. I was 16, a bit of a loser, and convincing people to make videos with me, and everyone was saying no, so I asked my dog to do it, and he had to. And so I think the fact that over time you're not only a talent, but you're also a producer, you're a director, you're kind of learning things a little bit slower than you would maybe in the traditional sense, where you completely break it instantly overnight. However, creators today do sometimes break it overnight. So I think that can be a lot more challenging, but I've really had like time to figure out each stage as it came.
But you stopped making videos. Your last YouTube video was like 6 years ago.
Exactly. I mean, it was lockdown was starting, and I was like, wow, I want to take a little bit of a break. Everything's crazy right now. I have these businesses where I need to completely focus on. Obviously, it was a massive shift for a lot of companies, and I realized like if I wanted to, really make sure that these companies succeeded, I had to focus fully on that. And also, I think to be a YouTuber, especially. It's something, as you know, making content and doing it well is a full-time job.
Right.
It's something you can't do as a bit of a side hustle. So I was like,
Yeah.
I'm really proud of what I did as a creator. Now it's time to focus on this next stage. And I thought I would come back one day, but it's been quite a few years and still don't feel the itch yet.
So you don't miss it at all?
I think sometimes I look at what people are doing, I'm like, that's amazing. That looks like a lot of fun. But when you actually remember all that goes into it and the mental kind of draining of like constantly being on this treadmill, it's tough, right? And so if I was going to do it, I wouldn't want to also have all of the other work that I'm currently involved in. I don't want to let anything slip. So, but I do think it's still, I might sound doom and gloom in terms of like the struggles of creators today. It's still a hugely important place to, I think, do anything that you want to do in life. Not only be an entrepreneur, but like I feel like creators today, it benefits so many different careers that you could go and just understanding how to make content and edit and all of those things. I think is super important.
When you think about now the companies that you see as a venture capitalist, in many ways, it feels like the creator economy is, it's kind of this three-sided story. There's the creators, there's the audience, and then there's the brands, and I guess maybe there's the platform. Maybe it's a four-sided story. But in there, it feels like, influencer marketing, for example. I mean, this has been a business model that has been around now for quite a few years. Where is there actually innovation in that category? What are the startups that actually impress you right now? Because in my mind, it feels a little bit like we've seen a lot of this, right? We've seen the technology that helps brands find creators, right? Maybe there's a way to help them filter better. We've seen the business models where it's helping them create the content. I guess my question is, what's new and exciting for you right now, given that I feel like we've seen a lot of it?
Yeah, I think in the influencer marketing space, we're building some incredible tech, but at the same time, a lot of it has so much edge cases to working with creators and humans that in terms of like a fully automated software that does absolutely every single part of a proper influencer marketing campaign, especially for enterprise clients, is quite difficult. So it's quite human heavy still, which is great. And we've built a great business with great people because of that. In terms of some spaces, I'm seeing some innovation. I mean, you're seeing what's happening right now with commerce on TikTok Shop. And there's a massive opportunity with the long tail of creators for them to be able to do work on TikTok with, small to medium to large size brands. And there's companies like UK which we're investors in, that have built like really great technology, obviously harnessing the power of AI to make that a far more scalable. I think when you're working in like the pure influencer marketing space that we work in terms of like creators working with big brands, you can't fully let go of the control that the humans need to have. Whereas like that kind of lower funnel TikTok Shop element is a lot more disruptable with tech.
Right. I want to ask you before you go, you've sort of had these two different halves to your career. One is the content creation side and one is the business side now that you've been focused on as of late. If you think about Caspar's why he wakes up in the morning, what drives you, has that changed over the past decade, given that you're now focused on the business?
I think it has changed. It used to be like I wanted to be this very successful creator. Now, kind of what drives me is helping creators become entrepreneurs and entrepreneurs become creators. I love to bring those two worlds together because those are both my passions. So yeah, it's something that's changed over time. But I always think when I was really young, I think the reason I wanted to become a creative was because of the entrepreneurial spirit of it. And I think it's such a great way of taking something from 0 to 1. And now anyone in the whole world could do it as long as they've got a phone and an internet connection. And I think with AI as well, it's going to just allow people to create way better content than they could ever before on their own.
And where does that come from, Caspar? Were you surrounded by entrepreneurs growing up? Was this a book that you read? Was it something your parents told you to do?
It was a bit of my mom being an entrepreneur and always trying new things. She even had a chocolate factory at one stage. And then I also loved what Richard Branson did. I read his book, and I was a big fan. Whenever I flew somewhere, I was always wishing I could fly on Virgin Atlantic, because I think they were one of the first people to have the screens on the planes.
Right.
And I just became obsessed with him. I was like, this guy is so cool.
Have you met him?
I did manage to meet him a few times. I even managed to be on a flight that he was on. And the best thing about him was, like, you can imagine a lot of CEOs or people like Richard Branson, when they're on a plane, they just want to chill and not talk to everyone. He was literally walking around the plane asking how everyone was doing. And then at the very end, he got on the mic or whatever you call it, and was like, "Hey, Richard here. Thank you so much for flying Virgin Atlantic." I was just like, "That's epic."
Great. Well, I'm sure that was a very full circle moment, and maybe you'll do business with Richard Branson someday.
100%.
He's involved in just about every corner of the business world, and so I'm sure you guys will do a deal together at some point if you haven't already.
Not just yet. You know what? Some people say never do deals with your heroes, so we'll see.
All right. Well, when you do it, if you do it, come back on the show and tell us about it.
100%.
All right. Well, thanks for coming on, Caspar. It's a great conversation, and look forward to seeing what you get up to down the road.
Thanks, mate. Bye-bye.
Well, that does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank Amazon Web Services, who is our presenting sponsor for this production. And I want to thank you for tuning in. We really do appreciate your viewership. I'm already excited for our next show tomorrow. Have a great rest of your Wednesday. Bye-bye for now.